Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Kroger, company that is a lot of people's favorites and even is Warren Buffett's favorite too, and seeing that their earnings are actually coming out on Thursday, and since there really isn't that much going on this week, I figured, you know what? Let's analyze this company based on their fundamentals and see if we can come up with a target share price based on those fundamentals. So with that said, let's get started with this analysis. We are going to start off with a dividend summary, guys. Kroger does pay a dividend of 1.67%, which ends up being 21 cents per share for an annual payout of 84 cents. Payout ratio is around 22.01%, which is pretty good. However, this payout ratio is not looking in regards to the free cash flow. We're going to take a look at the payout ratio in regards to the free cash flow, because free cash flow is everything when it comes to a company, and this is what they use to pay out a dividend, not necessarily the net income, which is what this one is portraying. The 5-year growth rate on this dividend is very, very good at almost 12%, 11.84 to be exact, with a 16-year consecutive dividend growth, which is again pretty reliable. Not a dividend aristocrat, but it is getting there. Ex-dividend date passed as of May 12th, payout date was June 1st, and they pay their dividends quarterly. Coming now to the calculator, we got the ticker symbol of KR, market cap of $36.7 billion, P of 23.18, which is a little bit expensive, off by 3.18 points, I guess you could say, but 3.18 is still fairly close to my 20 mark, and seeing that the current share price is around $50 or so, this might actually not be a pretty bad price to buy that in accordance to the PE, right? In accordance to their earnings. Let's take a look at this in regards to other metrics: shares outstanding, free cash flow, projected into the future, bring it back to today, and see what in the world we can come up with. Now, taking a deeper look into this dividend at 84 cents per share annually, this actually comes out to be, guys, $610.7 million being paid out in dividends every single year. And comparing this to the average 5-year free cash flow, once we subtract this from that 5-year average, they still have, guys, $1.6 billion in their 5-year average free cash flow, which is actually a payout ratio of 28.11%, fairly close to that of the payout ratio that they have to the net income. Now time to look at some fundamentals, starting of course with the net income. 5 years ago of $1.9 billion to 1 year ago $1.65 billion. That is a decrease, guys, of 13%, which is actually a fairly surprising decrease. I was actually not expecting to see a decrease when it comes to Kroger. This is a pretty major corporation, probably one of the biggest food retailers out there, and the fact that we have seen a decrease in the net income by a whopping 13%, fairly interesting. And not only that, guys, pretty much every single year they've been pretty much all over the place, right? So from 5 years ago to 4 years ago, they went up from 1.9 to 3 billion. Then 3 years ago they went down to 1.6 billion. Then they went up 2 years ago, ironically not when COVID happened, which is actually not surprising at all, right? Because stores like Kroger probably remained open, were allowed to remain open, and they made 2.6 billion, and then 1 year ago they went down to 1.7 billion. So what we can expect for this upcoming year is the fact that they might be a little bit higher than that of 1.7 billion, however lower than that of the 2 year ago mark. Coming now to the free cash flow, the most important profit metric that we have, because free cash flow, guys, is the cash from operations less your capital expenditures. This here is what companies use to pretty much do everything. All their excess free cash flow is used to pay out dividends, buy back shares, grow the company, and to pay down debt and make acquisitions, which I just consider that the same thing as growing the business. So very important metric, guys. You want this number to be increasing. Now when it comes to Kroger, it's actually increasing by a whole lot, which is actually kind of worrying, believe it or not. So they got 5 years ago of $604 million to 1 year ago of $3.6 billion. There's a decrease, guys, of 492%, and this gives them a 5-year average free cash flow of $2.2 billion. Billion with a B. Now, the reason why I said, guys, that this is actually concerning is because of the fact how much in their free cash flow they grew from 3 years ago of 1.5 billion to 2 years ago of 3.9 billion, essentially almost $4 billion, right? So that right there is not a consistent growth. It is an outlier, and we actually saw that being implemented right here because, well, they went from what, $1.5 billion 3 years ago to then $4 billion 2 years ago, and then they went down 1 year ago to around $3.6 billion. Now, granted, they did not go all the way down to, the $1.5-2 billion mark. Sure, I understand that. However, when it comes to the grand scheme of things, I actually foresee this to continue to go down, mainly because of the fact that retail, especially food retailers right now, are getting more expensive and more expensive. And if people can find better alternatives, I guess cheaper stores out there where they can buy their food, they probably won't go to Kroger. So their free cash flow might actually decrease within the next coming years. So this isn't really that consistent, and that's the reason why I am that worried about it. Taking a look now at the revenue 5 years ago of $123.3 billion to 1 year ago of $138 billion. That's an increase of almost 12% at 11.85% to be exact. And this is actually fairly consistent. Now, what is concerning a little bit here is that from 5 years ago to 3 years ago, they actually went down, I guess you could say. And then from 3 years ago to today, they went up. So it's kind of a mixed bag. I get that it is increasing. Don't get me wrong, it is. But understand that eventually when we get more numbers, and if these numbers in the future actually come back negative, then all of this chart gets pushed one to the left. Then essentially we might actually have a flat line. So understand that. Now time to take a look at some balance sheet numbers. Let's figure out if they can actually survive the big R word, right? The big recession that's about to come, which I personally believe is going to come. So taking a look at the assets minus liabilities. We take the assets, subtract the liabilities, and if this number is positive, which we hope that it is positive, and it is consistently growing throughout the past years, this pretty much is telling us that if things were to really hit the fan, they could still survive, which is a good thing, right? It's a good thing that we want them to not go bankrupt, because if we're investing in them, well, it'd be really bad if we invest in a company that went bankrupt, right? We don't want that. Now, when it comes to Kroger, they currently are at around $9.4 billion in total assets minus liabilities. And to the credit, within the past 5 years, they have been increasing it a significant amount. Now, from 2 years ago to 1 year ago, they essentially went down a little bit by around $100 million or so, but nonetheless, they still have around $9.4 billion, which is still fairly safe. Average total assets around $44.6 billion, average liabilities around $36 billion. Doing this difference, we get $8.6 billion. Looking now at the shares outstanding, the metric that companies tend to fail, especially newer companies, and even some big, well-established corporations too. The reason is because companies tend to issue shares when they feel that their share price is really overpriced, or when they feel that their company is just hype, so they just continue to issue shares, and it is no fault on them. So you want this number, guys, to be decreasing, not increasing. Now, when it comes to Kroger, it's actually fairly surprising in the good way. They actually are buying back a huge amount of shares in the 5 year, going from 870 million shares 5 years ago to today of 727 million shares. This is a decrease in the 5 year of a whopping 16.44%. And from the previous year to the current year, this is looking at 2 years ago to 1 year ago. 2 years ago, guys, they were 758 million shares. And then 1 year ago, they went down to 727 million shares. That's a decrease of 4.1%, which is again really good. Now, the reason why I'm actually fairly surprised in seeing this is because when it comes to buying shares, right, buying shares is used with the cash flow that they essentially have left after that dividend is paid. If they are buying back, guys, this amount of shares, they could easily switch this to essentially paying down their debts. So it's actually really good to see a huge share buyback, because if things were to really hit the fan, they could just switch this, and instead of buying back shares, they could just pay down their debt. Essentially, no fault is happening here, right? They're just reallocating their money into another part of the business to keep them afloat, which is again really solid. And lastly, looking at the cash equivalents, we take a look at this because we need to see how much cash they have on hand in order to come up with a target share price adjusting for debt. I'll take a look at this in just one bit. But currently, they're at around $1.8 billion with an average cash equivalents of $1.1 billion. And now, time to make some assumptions. Low, medium, high, using 3 different factors as always: revenue growth, projected share buyback, and the required rate of return. Guys, for the revenue growth, I like to use Seeking Alpha's growth tab, looking at the revenue growth year over year. the revenue growth forward, making an assumption between those two numbers. And actually for Kroger, those two numbers were fairly close, which is actually really good because it makes it easy for me, right? When those two numbers are close, it's a lot easier than if they are like 20 and 60, right? If they're like 3 and 4 or like 9 and 10, it's significantly easier for me to make an assumption. So it's also easier for you guys too as well. For the projected share buyback, we just saw the shares outstanding graph, using that as reference. And lastly, for the required rate of return, keep it flat 10% to match the S&P 500 on average. So for the low assumption, let's say a revenue growth of 3%, projected share buyback of 3%. This comes out to be $49.76. For the median assumption, revenue growth of 5%, projected share buyback of 6%. This comes out to be $55 on the dot. And lastly, for the highest assumption, revenue growth of 6%, projected share buyback of 9%. This is $58.70. Now let's adjust for debt. This is why we take a look at the cash and equivalents. And there's also another metric that I don't show, mainly because we just take a look at their liabilities already when it comes to the assets minus liabilities. But when you fill out the stock fundamentals, there is a line that says net debt. So what we do is we take the cash equivalents, we add the net debt, and if they have more cash than debt, then obviously this number comes up. If they have more debt than cash, then this number comes down. And as you can see right here, it does come down, guys, to $25.95 for the low assumption, $30.45 for the median assumption, and $33.39 for the highest assumption. Now, I personally like to also add a margin of safety on top of this target share price adjusting for debt of 5, 10, and 15%. And in doing so, this puts me between $22 all the way up to $24.65 for the low assumption, $25.88 to around almost $29 for the median assumption, and $28.38 all the way up to $31.72 for the highest assumption. So as it stands, guys, with the current share price of $50, well, we have some green here, right? We do have some points where we actually might be willing to buy this, right? We have the median assumption where I'm putting a 5% growth and a 6% share buyback within the next 4 years. This is at $55, right? So we are lower than this number, so this might be a pretty good buy at this point, assuming that you believe the target share price, not adjusting for debt, and also the highest assumption at $58.70. But as I always say in every single video, guys, this is not financial advice. None of this was. The graphs, all of that is public information. You guys can easily look at that in Yahoo Finance, Seeking Alpha, etc. And when it comes to these projections, it is essentially my assumptions, not my opinion. I'm not telling you guys what to buy. I'm not telling you guys that these are set in stone. It's all based off of what you believe. That's why I have this calculator available for free. Anybody can have it. It's in my calculators videos, as well as the book value one and a REIT one and a dividend tracking sheet. All of those things, guys, is available for free. You go in there. The link is in the description below. Just go in there. You come to this spreadsheet, make a copy, and you make your own assumptions. Because at the end of the day, every investment is the present value of all future cash flow. So if you do not believe my assumptions, which you shouldn't, make your own assumptions and see where your numbers lie. All I'm asking for in return, guys, for these 3 free calculators and dividend tracking sheet is just help me grow my channel. We're up to 650 subscribers. Absolutely insane. Oh my God. Thank you all so much. That's really all I'm asking for, guys, is just 30 seconds of your time. It's not even 30 seconds. It's more like 5 seconds of your time. Hit that like, subscribe, comment, and of course share to people that would like to learn how to invest using a fundamental basis. We have seen a lot of red in the market. I recently just put out a video showing the indices falling down a significant amount. In fact, the S&P 500 is in bear market territory already. It is down more than 20%. So right now, more than ever, it is very, very important to understand how to invest using a process. I'm not saying that my process is the best one. There are many processes out there, but it's still a process. And if you have people that would like to learn how to invest, especially during this market, then hit them up, show them my content, so that way they might be able to grow in the future when it comes to their finances. Taking a look now into this dividend, let's say that we make the average US income at $68,703. How much money would this give us in regards to a dividend annually, quarterly, and monthly if we put in 1 month's income into this company? Well, at the current share price, this would buy us 113.62 shares, and at the current annual dividends per share, this would net us, guys, an annual dividends of $95.44, quarterly dividends of $23.86, and a monthly dividend of $7.95. So it's not a lot of money, I guess you could say, right? We have analyzed other companies that for $5,725, we get 200, right? 150, 175. So when it comes to dividend, this isn't really that, I guess, efficient, mainly because of the fact that, well, they only pay out an 84 cents per share. But they do have a huge CAGR, guys, right? 11.84% in the past 5 years, and a consistent dividend growth of 16 years. So you're essentially not buying this dividend for what it is now, but you're essentially buying it for the growth of this dividend, which is actually way more valuable than just the current dividend today, right? So that's just something to note when it comes to this company in regards to their dividend. All in all, Kroger is a company, again, I considered buying. However, when it comes to food retailers, it's very, very, I guess, iffy, right? Because there's just a lot of competition out there when it comes to this, and I personally just don't want to have another food retailer, right? I mean, you have other mega giants, like for example, Target sells food, right? What they could be considered a food retailer essentially. You have Walmart sometimes that sells food, and you also have Amazon with Whole Foods, right? Amazon does own Whole Foods, so that's kind of where I'm getting at, is that they do have a lot of competition. So when it comes to that, it is just I just prefer not getting into this whole thing because their moat isn't that solid, right? It's very, very easy to go in and they already have a lot of competitors. But if you like Kroger, guys, then this actually might be a pretty good stepping stone as a starting point as to whether or not you want to buy it. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You guys can follow me on my new tech sites. The links are in the description below, as well as our Let's Play channel. Link is also in the description. So if you guys want to follow me, you can follow me there too. With that said, peace out. Be on the lookout for the next stock analysis video.